Supermicro is scheduled to report earnings this Tuesday after market close, with the release arriving at a moment when the company's projected operating performance and its stock price behavior remain materially disconnected. On the surface, consensus estimates point to one of the strongest growth quarters in the company's history. Yet, the market has continued to discount the stock, keeping it locked in a weak technical structure. This tension between improving fundamentals and deteriorating price action is the central issue investors must resolve heading into the earnings event, because despite strong forward-looking numbers, the stock has failed to validate that optimism through sustained upward momentum. Looking back at the prior quarter provides important context. Supermicro reported revenue of $5.02 billion, which missed analysts' expectations by 13.2% and represented a 15.5% year-over-year decline. The quarter was not just a revenue miss, but also included a significant shortfall versus consensus operating income estimates, reinforcing investor concerns around execution consistency. Over the past 2 years, Supermicro has missed Wall Street's revenue expectations 6 times, which has contributed to a persistent credibility gap between projections and realized results. This history explains why, even with sharply higher forward estimates, the market has been unwilling to re-rate the stock without confirmation through price action. For the upcoming earnings release, analysts are forecasting revenue of approximately $10.42 to $10.44 billion, which implies year-over-year growth of roughly 83.8% to 83.95%, a sharp acceleration from the 54.9% growth rate recorded in the same quarter last year. Adjusted earnings per share are expected to reach 0.49, also higher than the previous quarter, indicating that margin structure is not expected to deteriorate despite the rapid revenue expansion. Importantly, analysts covering the company have largely reconfirmed their estimates over the past 30 days, signaling that expectations have stabilized heading into the report rather than trending lower. Nonetheless, the company's historical tendency to miss estimates has left investors cautious, even as the magnitude of projected growth stands out relative to both its own history and sector peers. Sector-level performance offers additional framing. Within the IT services and other technology segment, some peers have already reported fourth-quarter results, providing early signals for how the market may react to earnings outcomes. Xerox delivered year-over-year revenue growth of 25.7% but missed expectations by 0.9%, and its shares declined 7.6% following the release. Applied Digital reported revenue growth of 98.2%, exceeded estimates by 14.8%, and saw its stock rise 8.1% in response. Across the broader segment, share prices have been largely flat over the past month, indicating neither broad-based risk-on nor risk-off positioning ahead of earnings. Supermicro, by contrast, is down approximately 3% over the same period and is entering earnings with an average analyst price target of $46.71, compared with a current share price near $29.15. This gap between analyst targets and market pricing reflects skepticism around the durability of earnings momentum, rather than a rejection of the growth narrative itself. Guys, 99% of people watching don't like or subscribe to the videos, so please take a second to hit that like button and subscribe. It really helps the channel grow. From a fundamental standpoint, recent developments continue to reinforce the case for sustained operational expansion. Supermicro's Taiwan subsidiary recently entered into a facilities agreement that provides a $710 million revolving credit facility with an option to expand total available financing to as much as $2 billion. This agreement strengthens balance sheet flexibility and supports working capital requirements tied to rapid growth in server shipments and platform deployments. In parallel, company disclosures highlight that server and storage segment revenue grew 50.2% year-over-year in fiscal 2025, rising from $6.5 billion in fiscal 2023 to $20.31 billion in fiscal 2025. This expansion has been driven by accelerating demand for liquid-cooled and air-cooled GPU servers, as well as PCIe-based AI systems designed for training and inference workloads across hyperscale, enterprise, and sovereign AI deployments. The composition of revenue further underscores the company's strategic positioning. The server and storage segment accounted for 92.2% of total revenue in fiscal 2023 and expanded further to approximately 97% of total revenue in fiscal 2025, reflecting increasing concentration in high-performance computing and AI infrastructure. Partnerships with vendors such as NVIDIA and AMD position Supermicro to deliver the latest GPU-powered platforms, which remain in high demand among cloud service providers and government-backed AI initiatives. Geographic expansion across Europe, Asia, and the Middle East adds another layer of growth optionality, particularly as sovereign AI programs and regional data center investments accelerate. Taken together, these factors suggest a fundamentally supportive operating environment with no obvious signs of structural demand weakness. Despite this constructive backdrop, the stock's price action continues to convey a markedly different message. The shares recently experienced a sharp upside move accompanied by strong volume, which temporarily shifted technical positioning to bullish and suggested the formation of a bottoming structure with the potential for breakout continuation. That move failed to sustain. The stock subsequently lost the $30 level, which had been acting as a key resistance-turned-support zone, and then continued lower. The next line of defense near 30.63 also failed, leading to renewed downside pressure and re-establishing a negative technical structure. These failed breakouts have reinforced the market's reluctance to price in the improving earnings outlook before confirmation through sustained trend reversal. The divergence between price and fundamentals becomes even more apparent when viewed through a longer-term lens. At the time of the last earnings release, when reported revenue was approximately $5.83 billion, the stock was trading near $48. Now, with revenue expectations near $10 billion, the stock is materially lower, underscoring the extent to which valuation has compressed rather than expanded alongside growth projections. This inversion highlights the primacy of price action as the market's ultimate signal. While earnings estimates, revenue growth projections, and corporate developments provide valuable information, the stock's persistent inability to reclaim key technical levels suggests that investor confidence remains impaired, and that any bullish thesis must ultimately be validated through price behavior, rather than forward-looking metrics alone. Heading into earnings, the technical framework resolves into three primary scenarios. The first and most constructive outcome would involve a post-earnings gap higher above the $30 level, which marks the upper boundary of the current resistance zone. A decisive move above this threshold would signal a bullish continuation and reopen upside pathways, initially toward the $35 area, with $41 again becoming a viable medium-term target. The second scenario involves failure to reclaim this resistance, which would leave the stock in a bearish structure. In that case, any downside gap below $29 would suggest continuation risk toward approximately $25.70, reinforcing the prevailing downtrend. The third scenario would see the stock remain range-bound between roughly $28 and $32 following earnings, which would imply neither bullish nor bearish resolution and effectively represent a continuation of consolidation, leaving capital tied up without directional clarity. In summary, Supermicro enters earnings with sharply improving revenue and earnings expectations, projected year-over-year growth near 84%, strengthening balance sheet flexibility through a $710 million revolving credit facility with expansion potential to $2 billion, and sustained momentum in its server and storage segment driven by AI infrastructure demand. Yet despite these supportive fundamentals, the stock remains trapped in a weak technical structure, having failed to hold prior breakouts and having broken below key support levels near $32 and $30.63. Until price action confirms the fundamental narrative through a decisive reclaim of resistance, conviction remains low. The upcoming earnings